Y'all having a good time in New Orleans? Good. So this is my hometown. I have an accounting practice here just down the street. And so I have 2 children, and so I did not go out last night with many of you guys. I know that when I woke up this morning and was bringing the kids to school, I was going through the app feed, and I saw a whole lot more people at Republic last night than I did at Sunrise Yoga this morning. So it's always fun to have a conference in New Orleans. It is a lot of fun to live here. As I said, I'm a CPA here, and I have a practice. I started my practice in 2012, really dedicated to building a firm I could run from anywhere in the world. And I'm laughing in my head about firm. What I built was a contract accounting service in my guest bedroom. I didn't mean to build an accounting practice. I just had these 2 children at home that I knew I had to be present for, and so when I went back into the workforce when they were starting to get older, I looked around at what was going on with technology, and 2012 was really the beginning of the sort of embracing of the cloud by accountants. Accountants are very, very similar to attorneys in that we are not real aggressive when it comes to change. We tend to stick with what we know. So when I looked around for accounting platforms, I stumbled on Xero and built my practice on Xero, and have been using them exclusively since. But I've really gotten into the habit of grabbing apps, learning a lot about apps, and that's how I got to learn about Clio. So a good chunk of my firm clients are small, very small, a lot of solo lawyers in very small firms. So that's what we do here in New Orleans. So we are going to talk about accounting as it pertains to law firms. I know, right? Woo! We're going to go through accounting concepts. So this is going to be a quick crash course in accounting concepts and theory, which sounds very boring, but it's important for you to understand the background of what we're going to talk about towards the end. So we'll do that. We'll understand why it's important, why solid accounting and bookkeeping practices are really important. We'll talk about dun dun dun, trust accounting, thing that gives everybody heartburn, right? And we'll wrap up with technology and how technology can be used to ease these pain points when it comes to legal accounting. All right, so let's start at the very beginning. Accounting is not about math. So for those of you who hate numbers, afraid of numbers, I mean, there's obviously numbers, but it's not math. So people would often say, oh, you're CPA, you must be really good at math. Nope, not so much. I mean, there's no calculus in accounting. Accounting is really about organization. Accounting is not unlike sorting laundry. So if we think about, I don't know why it's doing that. If we think about financial transactions, okay, so every time money moves one way or the other through our company, we have to associate those transactions with the right categories. So truly, accounting is more like sorting laundry than it is about doing heavy math. We just need to put the transactions into the right buckets. And the 3 big buckets are assets, liabilities, and owner's equity. Okay, did anybody take business in undergrad and learn this? Okay, so for those of the 95% of you who have not, I'll just go through a quick rundown on what each of these big buckets are. So assets are the things that we own. It's the things we have possession of. So that could be something like cash, that's easy, a checking account. It could be a building, our office building. It could be something intangible, like accounts receivable. So assets are the things that have value that we own. Liabilities are what we owe to other people. So something that it's the value of a right that someone else has to our assets. So that could be a credit card. We owe a credit card balance. It could be a mortgage on that building, so we owe a mortgage. It could be the bills that we have to pay in the next 30 days. Those are liabilities. And owner's equity is what's left over. So it's the excess of what we own versus what we owe to other people. In the same vein, when I talked about every financial transaction has a consequence, it really has two consequences. There are two sides to every financial transaction. And this is the concept of double entry accounting. It's a very old concept, and it makes sense. This was codified by a monk in the 15th century who said that if I give you something, you give me something back, probably of equal value. That's double entry accounting. So I want a goat from you, and I will give you, 12 bottles of wine. Those are the two sides of double entry accounting. I want some, I'm going to give you a bucket or barrel of apples today, and you owe me a peck, I don't even know what a bushel and a peck are, but a peck of wheat in the spring. Okay, so there are two sides to every financial transaction. We call this double entry accounting. Okay, so everybody's got it. We got some stuff, and we own some of it, or we owe it to other people. Every transaction has two sides, and accounting is nothing but sorting laundry into the right buckets. So that's Accounting 101. So what does this all mean, and why is it important? How many of you guys look at your financial statements for your firm on a regular basis? Okay. How many of you don't have financial statements that you get on a regular basis? I was working the Xero booth yesterday and earlier today and talking to firm owners or partners as they came through, and we would say, well, what are you using for your accounting today? And truthfully, nearly half said either nothing or Excel. Excel is a great spreadsheet. It is not a great accounting software. It works for a lot of people, and I get this. And please do not think that I'm sitting here to judge or to fuss. I'm a mother, but I will not do that to you like I do it to my 14-year-old daughter. Hopefully you like me more than she likes me right now because she's a 14-year-old daughter. But what I want to do is help empower you to make these changes. Excel is great for things. It is not great for accounting. So when we're talking about the importance of solid accounting, we are really talking about looking at financial data on a regular basis. And we can't do that if we're not gathering and sorting it on a regular basis. So we're sitting in the end of September right now. So the corporate federal tax deadline and individual federal tax extended deadlines are kind of where we are right now. There are probably a lot of people in here who are on extension, which is fine. Extensions are fine. But there are probably a lot of people who don't look at their financial statements except for filing a tax return. And there are a lot of people that believe that is the entire purpose of accounting. So I'm a CPA. I don't prepare taxes. And that boggles a lot of clients. They're like, well, you're a CPA, so you don't do taxes. No, we do things other than taxes. I don't do tax returns anymore. What I do is I help clients to run their businesses. So I give them financial data to make decisions about how they're going to operate their firms. But there are a lot of folks who literally want to check the box and get it done and move on and are not paying attention to what's going on a monthly basis. So imagine the power of what would happen if you had good financial reporting that was timely. So instead of looking at your financial statements in September or October to file the tax return, what if every Friday or Monday you looked at what was paid, what came in through the firm, what you paid out? Even if you did that for 5 minutes, imagine the power of paying attention to your financials on a regular, consistent basis. That's much more helpful than looking at it once a year. In order to do that, we've got to figure out a way to automate as much as possible, to make that data gathering and sorting as efficient as possible, and to put the transactions in the buckets that will give you the financial picture of your firm. a lot of firms, when they're starting out, are concerned with billing, obviously, with invoicing, getting money in. Really important. People are not going to show up in your front door and give you money unless you ask them for it. You have to ask to be paid, and then they will mostly pay you. So that's really important, and that's probably a lot of firm owners who maybe are starting their own firms after leaving a big practice. That's probably the first step, and an admittedly important step, to ask for money. But it is not the entire financial picture of your law firm. You need to know not only what cash is coming in the door, you need to know what should be coming in the door. You need to know what you have worked for but can't bill. We need to know what it costs us to run our practice from top to bottom. So when we use a package like Clio, which is fantastic, we still need an accounting system on the back end to grab all those other costs. Okay, so we need something that will help us analyze what it costs from top to bottom to run our firm. And imagine what difference that would make if you knew how much electricity costs you, how much you're spending on mortgage interest. And I know you're groaning inside. A little bit of you's like, oh, I just don't want to do this. But sitting here in 2017, almost 2018, it is very simple. It does not have to be complicated. There are two main financial statements we want to pay attention to. First is the balance sheet. It shows us that accounting equation with numbers. It shows assets, liabilities, and owner's equity. And it's a snapshot of something at a point in time, of the picture in a point in time. Income statement is the activity over a period, revenues minus expenses, so that's the bottom line. So when we look at a balance sheet, which there's an example on the next slide, we'll see at any given date, generally it's the last day of the year, the last day of the month, the last day of the quarter. At that point, what are those balances? What is the total amount of assets we own, total amount of liabilities we owe to other people, total amount of ownership in dollars that we have in the firm? So here's an example of a firm balance sheet. Operating checking account, we've got some accounts receivable, a building, totals to $240,000. We have a mortgage on the building, some payables. Net ownership of the owners is $80,000. So you see the $240 at the top and the $240 at the bottom. That's our accounting equation. Probably the more interesting of the financial statements would be the income statement. So this is showing revenues and expenses over a period of time. Usually it's a month, usually it's a quarter. Your tax return is basically an income statement over a whole year. Okay? It shows the profitability of the firm. So here's what a typical firm income statement might look like. Legal fees, $175,000. We got a little interest, some other income, got all kinds of expenses. It's very expensive to run a law firm. Very expensive to have a small business pretty much anywhere, any kind of small business. But we have the different buckets. Those are the buckets we were talking about. This is our laundry sorting. We took in some money, stuck it in legal fees. We paid our some advertising, marketing, stuck it in the marketing bucket. So you see how we're going from the transactions, we're sorting those out, and we're putting them on lines in the financial statement. It's not magic, it's just organization. Income statement, as I mentioned, is the starting point in calculating tax liability. So that one's real important. And not only just important at the end of the year, it's important throughout the year. Because you know what stinks is getting a huge tax bill, at the end of in April or in October when you finally do your tax return. What if we paid attention to it every month, and either saved money? If we're making money, which is awesome, we need to save for taxes. If we're not making profit, then we're gonna rest a little bit easier on the tax side, but we're gonna go out and try and get some more business because we want that number to be up. So those are the two financial statements that we really want to pay attention to, balance sheet and income statement. But you guys are attorneys, and some of you probably do have business or accounting backgrounds. I know I've actually talked to a few of you that had accounting backgrounds, but probably a chunk of y'all don't. So looking at a spreadsheet or a financial statement doesn't make you real happy, right? It's not the easiest thing to process, all the lines and the numbers. What if we can give you KPIs and dashboards. And you're like, Amanda, what is a KPI? I don't know what that is. Don't do this. I practice family law. A KPI is a key performance indicator. And a dashboard is a group of pictures. It's basically what it boils down to. So a KPI will give us a number, like a one-shot number, and the dashboards will give us pictures. And instead of looking at the financial statements in rows and columns and spreadsheets and da-da-da-da-da-da-da, we can look at a couple pages of snapshot things and make decisions about our practice. Now, we can only do that if all that underlying stuff exists. All the good organization, those financial statements and transactions have to be organized. We've got to do our bank reconciliation, or somebody has to do it. But then we can get to the point of using KPIs and snapshots. So what if instead of giving you a big spreadsheet of terms and columns and rows, what if I said, let's talk about some things, some metrics that are meaningful? Most of these are ratios, the financial KPIs. So profitability, we'll look at in a second the detail of that, but that's how profitable are you? How much of your income makes it to the bottom line? Realization is of your folks that are working, how much of that are we billing? Okay, so if we're paying salaried staff for 2,080 hours a year, how much of that time are we billing in dollars? Collection is, well, we're asking people for money, but not everybody's giving it to us. So what does that look like? Days billing and lockup, we'll talk about detailed calculation in a second. Revenue per FTE. An FTE is a full-time equivalent, so it's basically one person, one full-time person on your staff. So how much revenue are we taking in per full-time staff person? Fee per client, so different areas of law, different ranges of what is good. So fee per client, some of you guys do, corporate immigration. It might be big, huge fees. Some of you guys might do family law, and you're taking in dollars at a time. One is not better than the other, but we just need to analyze and say, okay, well, this month, what does it look like compared to next to next? Acquisition cost per new client. If you are in a growth stage of your firm and you are looking to go out and get lots of new clients, what is it costing you to get any of these new clients? We'll look at that calculation in a sec. And then non-financial. So I'm an accounting dork. I love dollars and bank reconciliation, all this stuff, but there are other ways to measure the success of a business besides dollars. So we can look at client satisfaction. That can be a non-financial KPI. How do we, can we survey our clients and see? I mean, we might want to do this and we might not, but it's another way to measure success in our firm. Website views, new clients per month, so forth. So the big question is, like, what is important to your firm? There are, I don't know, 100 so people, 200 people here. There are probably as many different answers as to what is important to your firm. I, as a practicing accountant, never want to have a huge accounting practice. What's important to me is to be available to my children, to be able to travel, to have a good lifestyle. I mean, I certainly want to make money. I certainly want to be respected in the profession, but it is not a goal of mine to scale to adding 100 new clients a month. It might be that for you guys. So what's important is to figure out what is your strategy for your firm, and how can we measure that and track the performance. So if your firm strategy is a roadmap, the KPIs are the GPS coordinates of where you are now. Okay? So if your firm strategy is a roadmap, I want to go this way, it matters less where you are than how to get from where you are to where you want to go. Okay, so those KPIs can take that financial data, that cumbersome, nitty-gritty 2 cents off data, and turn it into something that you guys as attorneys, and I know you're incredibly busy, can look at every month and say, all right, we're going the right direction. Here are a couple of calculations I just want to show you, because I want you to understand how we get from the financial statements to these KPIs. So when we're looking at the profitability ratio, net income over legal fees income, we're trying to figure out how much of that legal fees income, these are off, the 175 should be at legal fees, how much of legal fees makes it to the bottom line. So our net income bottom line is 54,000. Our legal fees of 175, which would be our ordinary operating income, right? We're not going to compare it to interest or other ancillary income, but how much of our legal fees are making it to the bottom line? 31%. Revenue per FTE, so if I'm taking in 175,000, that's supposed to be legal fees, and I have 7 FTEs, this is what I am grossing per person per month. So is it good, bad? Depends, but that's how we calculate that. Acquisition cost per client, so this one's a little tricky. We're going to take 2 lines in the buckets. We're going to take marketing expense and business development. We're going to add those together, and this could be whatever you consider an acquisition cost. It could be advertising. It could be, you might have a social media manager specifically for the purpose of generating new business for you. Maybe that goes in the calculation. But divided by the number of clients you've acquired over the month, that's the acquisition cost per client. So do you see how I'm going? We're taking all this data and summarizing it into these indicators. Days billing and lockup, this one's a little complicated. So we're going to take our accounts receivable being the bills that have gone out the door. Okay, so we have calculated what people owe us, clients owe us, and we have asked them for it. That's accounts receivable. The bills are at the door. WIP, work in progress, is you can get that number if you're using Clio. There is a report in Clio that will give you work in progress. But that would be work we have done, but not asked anybody to pay us for yet. So we're looking at all the work we've done, all the effort we've put out, divided by our daily fees earned, which would be whatever we've earned over the last year, divided by 365. And that will tell us how many days of work we're waiting to get paid. So that means, in this case, it's 28 days of work that we have not been paid yet for. That's actually probably pretty good. Probably a lot of you guys, or a lot of firms in general, would have much more, but how many days of billing are we waiting on? Again, this is incredibly important. One thing you take away from this KPI discussion, it's not the value that's important, it's the trend over time. And by over time, I mean by month. You can't look at a trend. Trends over each tax return year are not going to be as meaningful as every January, February, March, April. Because if I'm just looking at the tax return that just got filed, I know that a few of you filed your tax return last month. If I'm looking at the tax return that just got filed, that includes data from January of 2016. There is no chance of me turning that boat around, right? We're almost 2 years out. So timely, accurate data is how we need to make our business decisions. And then we talked just a second about dashboards being the pictures. These are a couple of add-ons for Xero that work really well, that turn all those numbers into pictures. Futurely, Fathom, Spotlight does that as well, where we can get graphs. Green is good, red is bad. Here's a pie chart, visual interpretation of our underlying data. So trust accounting gives attorneys nightmares, and with good reason. This is probably the most commonly prosecuted infraction against attorneys is trust account issues. So it's not complicated. It can be very simple if you remember one thing. The trust account is not your money. Not your money. It is your client's money. You can't mix them. No commingling of funds ever. Like never, ever, never, ever commingle client funds. You can't do it. Not even for a second. This was an actual fact pattern where an attorney, I think he was in Florida, got a settlement, put the money into the firm operating account, not into the client trust account, immediately transferred it out. And there was an investigation, everyone admitted there was no harm, there was no, the funds were never in jeopardy, but he still had his license suspended. Why? Because it should not have gone into his operating account. That seems pretty obvious. I mean, we read this stuff all the time, these cases where, a lawyer was, found to have used all his money to buy a boat and who does that? Nobody does that. But what they do is accidentally commingle by leaving your money in the trust account too long. Okay, so think about the converse of that. It's obvious. You get a client settlement check, you put it in the client trust account and disperse it. What's not so clear is I've got all this client money in the trust account. I have earned it, right? I've done the work for it. That is my money now because I've earned it as an attorney, and you take an inordinate amount of time to take it out. Okay, so I see a bunch of eyes like, oh, crap. You got to do the reconciliation, right? So this goes back to good data, good accounting, where you can't take the dollars out unless you know how much they owe you. You don't know how much they owe you until you do the billing. You don't know how much the billing is unless you've been keeping track of your hours and your client costs. Well, we don't know how much we've paid in client costs because we haven't reconciled the bank account in 3 months. Do you see where I'm going? Like, it's all got to be concurrent. We've got to keep up with it so that we can take our money out and not be in jeopardy of trust account issues. Okay, so just in case anybody's brand new, just hung out their shingle straight out of law school, trust accounting requirements. You have to establish an IOLTA account. Do you guys know what that is? And I'm sure most of you do. But for anybody who doesn't, an IOLTA account is a bank account where the interest, any interest earned on the account, is swept out immediately into funds for social justice. So you're holding a lot of money, sometimes a lot of money on your client's behalf. The banks are obligated to pay interest on that, but you don't get the interest as the attorney, and your clients generally don't. Sometimes they do, but for the most part, if you're looking at just a regular old trust account, that money gets swept out, that interest gets swept out into funds for social justice. That's an IOLTA account. This is an interesting thing that I don't have on the slide, but I want to point out, is that when you open an IOLTA account, you have to use the EIN of the Bar Association. At least, I assume it's nationally, at least in Louisiana for sure. You use the EIN of the Bar Association. So if there was ever any question that was your money, it is not. Like, it is not your money. The account has to be kept in a bank where you have a law office, and lawyers can't deposit their own money in the trust account except to pay bank service charges. So our firm does a lot of catching up, where it's just kind of gotten away from somebody, and there's certainly no maliciousness, but it's just the accounting has gotten away from someone. So we do a lot of cleanup of trust accounts. I will tell you that often we find that there's a difference because of bank charges, and it's not the service charges, because in general, banks do not charge you to have an IOLTA account. Like, I have a Chase account. They charge me $10 a month. In general, IOLTA accounts are not paying service charges, but what they are doing a lot of times is charging you for check printing. So often when you call the bank and say, hey, Whitney, I need some, Whitney's like the local bank in New Orleans. Hey, Whitney, I need some checks printed for my trust account. Often, they will debit the account on which the checks are created for. Well, that's not a problem, but you got to fix it. You got to put the money in to pay for it. The check printing goes on you, right? So a lot of times when we do this reconstruction of trust accounts, we'll find that the difference is an accumulation of check printing charges. So if you haven't paid attention to that, go run and check that out. The ABA's model rule on financial record keeping. So we're going to go through this piece by piece because not only is it important for you to know, but I want you to see how technology addresses each one of the requirements now. So the first is that we have to track all the disbursements and deposits through the IOLTA account. We have to make sure we keep track of the date, the source, the description, and the client for whom the money and funds are being held. We have to have a report of this, and it's called a trust ledger report. So that's one of the requirements. The second is that we have to reconcile at least quarterly. In Louisiana, the requirement is quarterly. Although, I submit that if we just do it every month, it's a heck of a lot easier to find differences, and it's always there. So if we just get in the habit of doing this every month when the bank statements are issued, well, we've met that requirement. It's done at least quarterly. Copies of deposit slips, bank statements, check stubs, cancel checks, and client checks have to be kept. But ABA also says that we can use electronic records. So we can scan all of this stuff, all these cancel checks and deposit slips and all the pieces we have to keep. We do not have to keep the paper. We can keep electronic copies as long as they can be printed. Xero has that ability, so when I load client transactions up into Xero, I attach to the transaction the relevant documentation, and if there was ever an examination, I could print it out from there. Same thing with, if you're using Box, Dropbox, Share, whatever document storage you're using, as far as I know, they all have the capability of being downloaded and printed out. So you don't have to keep the paper. And just remember, only a lawyer can sign the checks. So it's on you. This is like the buzzword in legal accounting right now, I feel like. Three-way reconciliation, what does that mean? 3 things we have to do every reporting period or every month. One is the bank account reconciliation. What that means is we have to look at the bank accounts, we have to look at the bank's version of what they say we have and make sure it's what we think we have. So every month, we need to look at the hard copy of the bank statement and look at the bottom and say, okay, well, the bank says that this is what we have. Do our financial records agree? And any differences need to be listed out. And there are differences, and that's, as long as we know what the differences are, that's usually okay. But if you have a bank account balance, the bank says $12,000, and you say, oh, I thought we only had $10,000. Oh, wait, we wrote a check for $2,000. It hasn't cleared the bank yet. A reconciliation means listing out the differences or the details. So a bank reconciliation is bank balance to your balance. That's number 1. Number 2 is the trust reconciliation. So knowing that, okay, we have $10,000, who does that $10,000 belong to? That sounds like a balance sheet, right? We talked in 17 minutes ago about a balance sheet, assets and liabilities. It's a balance sheet. That's important because we're going to talk in a second about using technology to get what we need out of it. Well, Xero is a general ledger small business accounting platform, as is QuickBooks. They don't natively have a trust reconciliation there, but they do all have a balance sheet, and that's what that is. So a trust reconciliation is how much money do we have and who do we owe it to? And then the third would be the client trust ledger, which would be a statement of activity. Our beginning balance at the beginning of the month was this much. These people put money in and out, took money in, took money out. Here's our ending balance for each one of the people, each one of our clients. Okay, so that's a client trust ledger in Xero. It's an account transactions report, the way I set up Xero. It's account transactions report. It shows beginning balance, plus and minus all the activity for the month, ending balance. So this is your 3-way reconciliation that everybody's so scared of and alleges that doesn't exist in accounting software. It does. You can do it. You don't need trust-specific software to do it. We can use regular accounting software and just get the reporting out we need to hit these 3. All right, this is the big one. The great debate, 1 set of books or 2? Everybody's like, what does that mean? Means, do the funds that belong to your clients go on the financial statements of your law firm? And there are people who say yes. I adamantly say no. That is not your money and should not go on the financial statements of your law firm, period. And a lot of people do this. This is a commingled balance sheet. So we looked at a balance sheet earlier. This is what one looks like, and we've got client money in it. Okay, so client trust account, $110,000. If I'm just looking at the balance sheet, I say, oh, my assets, that's $350,000. That's a lot of assets. Or my bank is looking at $350,000. That's a lot of money. Well, a third of it doesn't belong to me. It should not go on the financial statements of the firm. And then somebody, this is devil's advocate, but Amanda, there's an offsetting client liability on the other side, so it nets out. Okay, so yes, it does net out. It does net out. We're showing that it's not our money by way of that client trust liability. But I submit that we're going back to the big picture of running our firm. We want to look at KPIs. We want to take this data and make some cool pictures and be able to easily run our business. This is going to distort our KPIs. It shouldn't be there. It's not our money. It doesn't belong up there. So if anybody tells you that it does, you say, I heard this chick in New Orleans, and I was hungover, but she told me that I shouldn't do this, so I'm leaving. No, I'm joking. And how great is it that Clio has a hangover station? Do you think they do that? Like, if Clio was ever in, like, Des Moines, do you think they'd have a hangover station? So this is what I say it should look like. A firm balance sheet and a trust balance sheet. So we have our firm operations, the firm assets, the firm liabilities. And then we have the balance sheet for the trust, which is also our trust ledger. So separate. Now, how do you do that? You got to run them in two different companies in Xero or in QuickBooks. Okay, so you have to just run them in two different companies. So I have one Xero organization, is what Xero calls the file or the company. I have one Xero organization that I run all my operations through. My billing goes through there. That's the one I connect to Clio. That's where my company credit card is run through. That's where we're paying the mortgage, whatever. That's the company firm activity. But then I also add another Xero organization, and I call it, how many of you guys are from Louisiana or from the South? Okay, so when I was doing these demos for a long time for the Bar Association, I would create fake data, and it was a Xero-specific demo, so I would put stuff in Xero, and I always used the law office of Edwards. And so it would be like law office of EWE, and it was the big bank of Crowley was always my accounting, my operating account. Anyway, so we have a law office of John Smith or Edwin Edwards, and we have the law office of John Smith, Edwin Edwards - trust. And what I can do when I segregate those in the accounting software is I can take that trust company and I can dummy proof it. So instead of having the option of depositing classifying deposits to revenues, I take that option out. And my chart of accounts, which a chart of accounts is the list of all the buckets, of all the accounts that you can possibly hit. Instead of having assets, mortgage, accounts payable, which is what it would default to in Xero, I import a list of accounts that is nothing but basically client names. So I would have client trust liability, A. Aguillard, client trust liability, D. Barry. So I'd have one for every one of my clients, and when a deposit hits the bank account, me or my admin staff who are booking this can't mess it up. They have to pick a person. They can't put it in fees income. They can't put it in they have to pick a person. So by segregating out the trust account, I can create sort of a fake reality, a fake organization that's dummy-proofed. That also means that if it's only my trust account stuff over in that Xero org, I can use the report templates that are over there to run my three-way reconciliation. I don't have to extract any data out or filter any data out. If I went back to this one, and probably some of you guys are doing this. I know that some of you are because you've come by the booth. But okay, I say, okay, well, here's your balance sheet. Run me a trust reconciliation. Like, okay, well, you're going to have to export this to Excel, show all the sub-accounts, if that's how you're doing it in QuickBooks, where you've got client liabilities as sub-accounts. Show all of that, send it out to Excel, extract all the stuff that needs to be pulled out. I mean, there's a lot of data manipulation. If I do it this way, go to the trust org, run a balance sheet, run an account transaction report, run a bank reconciliation, I'm done. Push button reporting right there, just because I've segregated it into separate things. So it's accurate because my firm balance sheet is accurate because it does not include money that doesn't belong to me. And secondly, I've just eliminated, some time, and it's more efficient. Okay, so the pros: accurate firm financials, accurate KPIs, then I can start to plug my dashboarding apps into only the one on the left. Dummy-proof the data entry. I can now have, admin staff help me and not live in fear that they're going to screw it up and I'm going to go to jail. Push button reports for meeting the trust requirements. And what is it going to cost me? An extra subscription, an extra software subscription. Okay, so I've given you so much stuff that you need to run home and do, right? You're like, oh, I'm never going to sleep anymore. Amanda says I must do this stuff. But technology will fix a lot of these things for you. It'll take care of a lot of this for you. So let's just look at what running a firm looks like right now for a lot of folks. We've got bank accounts, invoicing, paying bills, payroll, a lot of fun stuff in there. All right, invoicing. We'll start with that one since it's the one that is probably the most urgent. Got to get paid. So old school invoicing, printing and mailing invoices. Who does this? And I'm not judging, I'm just asking, and you don't have to raise your hand if you don't want to, but who does this because their clients demand it? Who does it because they've always done it this way? Yeah. So printing and mailing invoices, paper invoices, send out the invoice, wait for the mailed payment to come back, and when it doesn't, then you're like, oh, I should probably check on this, and then you send another invoice, and they still ignore you, and then you send a statement with a big, mean, past due stamp on it, and you're like, this will definitely get their attention, and they'll definitely pay me now. And then they don't, and so then you have to call. So that kind of stinks. Calculating your billable hours by hand, keeping a Post-it note. Client such and such, I worked 1.3 hours. Not very efficient. So this is where a lot of law firms live right now. Bank accounts, getting bank statements in by mail. So I was when I was in college at the University of Louisiana Lafayette, where I grew up. I did an internship in the summer and did basically what I do now, but just for a lot less money. And I did bookkeeping and accounting stuff, and we would wait for the bank statements to be received in the mail. The firm would get a duplicate copy of all the bank statements in the mail, and then on the 4th of the month, it was like a mad dash to get everything input, because everything would come in at once, and we'd have that was when they sent you the checks back, you remember? And somebody had to sit there and sort them. Do you remember this? I say this it's 20 years ago. Sort all the, 1001, 1002, and sort them all out and file them, and that's what I did. There are still people that do that wait for the end of the month for a paper bank statement to come in the mail. It's not a good use of your time. I want to be able to leverage, I want to spend time on accounting when I have time. Using technology, Xero or the other guy, those bank transactions will come in for me. I don't have to wait till the end of the month. So I can use my mobile device, and I can sit in waiting on my children, which I feel like I'm always waiting on my children. So soccer practice, I don't know why they have to get there an hour ahead of games, but whatever. So I can sit there and, on my iPad and reconcile on my iPad. With the bank transactions come in, I can do yesterday's transactions today. I can keep up with it. I can leverage these small chunks of time and not wait till the 4th of the month for the bank statement to come in. Bills. So we're talking about paper payables bills, waiting for bills to be mailed to the office, manual check writing. Somebody loses it, it's pain. There are ways around this with technology as well. And payroll. Using spreadsheet to track staff hours, payroll running, and taxes filing manually. If there is a high-risk, low-benefit proposition in the world, it's running your own payroll. There is no need for anybody to run your own payroll. It's a way to get in a whole lot of trouble real fast for not a lot of savings. There are products out there. Xero does have payroll included. I know QuickBooks has that functionality as well. There are third-party apps like Gusto. It's great. Most of my clients are on Gusto, where I call it a nominal fee, $50 a month or so. They will do all of that for you. They will do all the things for you. So payroll is something that I just don't mess with. The cloud isn't coming. The cloud is here. So, 11 years ago, 12 years ago now, gosh, we all left our offices in New Orleans, and everybody on Friday afternoon was like, all right, see you on Monday. This is August 26th. Left our offices on Friday afternoon. Okay, see you on Monday. I hear there's this hurricane that's going to Florida. Oh, wow, terrible for Florida. Monday morning, the levees break, and the city is destroyed. And I get chills when I talk about it. I know people from New Orleans still have the feels about that. But if you had a small business in New Orleans, 80% of the city was underwater, so you were likely flooded. And if you weren't flooded, your data living on servers was likely ruined because of, y'all know how hot it is outside right now and humid. Imagine a month earlier in the summer and 8 feet of water through the city. It's humid, it's 100 degrees. Even if you didn't physically flood, your servers and your data, your hard data was likely damaged or ruined. And even if you weren't physically affected in one of those two ways, like by martial law, you could not enter the city of New Orleans, so you couldn't get to your data. So in my head, that event really started to make a lot of folks think about data storage and cloud-based data capabilities in a reactive way. So we're going to have redundant data, store it off-site. We're going to have access to it if there's an emergency. So that's data thinking in a reactive way. But sitting here 12 years later, the cloud it's not reactive. If we think about it in a proactive, forward thinking, it opens so many doors for us now. I, as a CPA, have my office in New Orleans. All my staff live in other places. One lives here, but he doesn't come to my office. I can't do that without the cloud, without fully embracing the cloud. There are a lot of law firms, and I know that's why we're at the Clio Cloud Conference, that get this, but there's still a lot of folks that are on the fence. They're like 1 foot in, 1 foot out, not real sure. What about security? Don't know if I want to worry about this. I don't want to retrain my staff. I get it, because we were in the same boat, and I hear this. I talk to accountants and bookkeepers across the country, and they all know they need to be there, but they just can't commit. I'm telling you right now, sitting here in September of 2017, if you're not in the cloud, you're getting left behind. You are. Because attorneys who have figured out the way to leverage technology and leverage cloud computing are beating you. They're more efficient, they're getting better clients, and they're making more money. So the cloud is not coming, the cloud is here. So bank reconciliation means taking all your bank transactions and putting them in the right buckets. Probably for you guys, 90% of your financial transactions come through a bank account or a credit card account. Think about, you get money from a client, it gets deposited into your bank account. You go out tonight to, I'm trying to think of a good example of a restaurant you should hit while you're in New Orleans. You go out to, I don't know, who went someplace really great last night? Pat O'Brien's is the answer. That's the winner right there. Pat O'Brien's. You get a couple hurricanes, it's like $58, and then you run it through your credit card, and you're like, all right, well, that's a business transaction going through a credit card feed. So probably 90% of what you guys are doing is going through some kind of data channel that can be captured automatically. So link it to Xero, link it to another platform, you get your arms around automatically 90% of your stuff if you're getting a feed in. If you're using Excel, you're not getting a bank feed. You're going to all of your different bank statements and writing them down and putting them in the right column. You need a bank feed. Bank feed only happens when you embrace technology, and it will automate. And there's some cool stuff that we can do with reconciling these transactions. And if you want to stop me after, I'll tell you all the tips and tricks, because this is such my jam, being efficient about bank reconciliation. We can set up bank rules and criteria and bulk coding and all these things, so you don't have to physically code every transaction in the software. Artificial intelligence, right? Machine learning, all the scary stuff. This is where it's going to happen first, for accounting, is bank reconciliation, where you're not going to have to make those decisions. It's going to be done for you. That's good. That's good. Why do you have to be the person that types in AT&T telephone expense every month? It's the same thing every month. Is that a good use of your time? No. Let the bots do it for you. Collecting from clients. LawPay is outside. They're great product for collecting clients via Clio. We can do it as well through Xero using Stripe or PayPal, but let the systems chase those clients for you and get the money for you. Paying employees, I mentioned Gusto earlier. Again, very high risk, low reward proposition to do your own payroll. Pay somebody a fee and do it. And you know what the great thing about this is, and there are folks here who are really into apps like I am. The great thing about all these apps that are cloud-based is you give them a credit card, you pay a certain amount a month, you change your mind, you stop paying them. Like, there's no commitment for most of these. You like Gusto, you like Xero, you like whatever, and then you don't the next month. You just stop paying it. With these software as a service SaaS products, there are usually no long commitments. So we can try new things. We can try scheduling tools. I'm sure there are a bunch of them out there. Try it, don't like it, stop paying for it. There's not a huge license commitment, Cash outflow, same thing. When we have all of our data in a cloud-based package, we can add on these software packages, and some of them are really good about forecasting cash flow. So they can go in and look at that bank data and look at our history and look at what bills we have coming up and give us some forecasting automatically, like literally plug and play. Understanding financials, again, dashboarding, KPIs. I'm not sitting there calculating these for you, the systems are, okay? So if I send you as a client, I send you a dashboard of a chart. I don't have my colored pencils out doing it. It's a software package that reads all the data from Xero and puts it into nice, pretty pictures for you guys. Mentioned 85% of transactions go through, bank feeds download to the accounting system, and automatic coding eliminates manual data entry. Just going back through these, electronic billing of clients, credit card payments through integrated payment processors, keeping the accounting system seamlessly up to date, so we're reminding the people who still owe us and not bugging the people who actually don't. Paying employees, third-party processors is the way to go. Virtual contractors is a viable option. A lot of people doing outsourcing. Real-time cash position using the dashboards, electronic bill payment and scheduling, supporting documentations attached as well. So using technology to pay these bills, something like bill.com or HubDoc, those are apps that will take images of the bills underneath and keep them safe in your accounting software. And understanding financial position, again, the idea that that if we plug in one of these on top of our accounting software, we can get something that's very easy to use. In wrapping up, I'll say this. I hope everybody has a wonderful time here in New Orleans, my hometown. It's a fantastic place. And if you want to play the funnest game with me ever, we can talk about where to go for breakfast tomorrow before you leave while we're eating dinner tonight. I like to always do that. We're always talking about the next meal at the last one, so we can certainly do that. Have a great time in New Orleans, but I would encourage you to really take probably 3 days between now and the end of the year and get your financial house in order. Look at apps, try new products, reconcile your transactions from the last 4 months if you haven't. Get your trust account set up, get it locked down. Really buckle down, take 3 good days to get your financial house in order and that'll set you up to have just a smashing 2018, which is right on the corner. So thank you. I'm happy to take questions. There are mics if anybody has anything to add. Thank you.